What if I told you that the money you are working for every single day is quietly losing its power, not by accident, but by design? What if the system you trust is slowly draining your wealth year after year, while making it look completely normal? This is the reality most people never see, and once you understand it, you can never unsee it. Welcome to Gold Silver _ Scope, where we break down the truth about gold, silver, and the financial system in the simplest way possible. Right now, what you're seeing in the global economy is not chaos, it's a pattern. The purchasing power of the dollar has been falling for over a century. And this is not something new. Every year, your money buys less. Your savings lose value. Your effort becomes cheaper. And the reason is simple. Inflation is not a mistake, it is a policy. Think about it like this. You work hard, you save money, you plan for the future. But if the currency itself is losing value, then your savings are silently shrinking. It's like running on a treadmill that keeps getting faster. No matter how hard you try, you stay in the same place or even fall behind. And this is where most people misunderstand the system. They think something is broken. But in reality, the system is working exactly as it was designed to work. It slowly reduces the value of money over time. And now, we are reaching a point where the effects are becoming more visible than ever. So the real question is not, why is this happening? The real question is, how do you protect yourself? To answer that, you first need to understand what real money actually is. Because when people hear gold and silver, they think it's all the same. But that's not true at all. Just like dollars exist in different forms, cash, bank balance, digital numbers, gold and silver also exist in different forms. And each form comes with a different level of control, safety, and risk. Some forms give you true ownership. Others only give you an illusion of ownership. And this is where things start to get serious. Because many people believe they own gold or silver, but in reality, they don't. What they actually own is a promise, a contract, an IOU, something that says, you have exposure, but not real control. And here's the problem. A promise is only as strong as the system behind it. And if that system is weakening, then those promises become weaker too. This is why understanding the difference between inside the system and outside the system is so important. Because assets inside the system can be controlled, frozen, or even restricted. But assets outside the system give you independence. And this brings us to one powerful truth. If you don't hold it, you don't truly own it. Now think about that for a moment. Because most people today are investing in things they can't touch, can't access directly, and can't control in a crisis. They trust digital entries, contracts, and institutions to protect their wealth. But what happens if that trust breaks? That's exactly what we're going to uncover. Now that we understand the difference between real ownership and paper promises, let's go deeper into how most people unknowingly stay trapped inside the system. One of the biggest examples of this is paper gold and paper silver. These are financial products that are designed to track the price of gold or silver, but they are not the actual metal. And the most common form of this is ETFs. For example, many investors buy gold through ETFs thinking they own gold. But in reality, they own shares in a trust. They don't own physical metal. They cannot take delivery. They don't know exactly where the gold is stored. And they have no direct control over it. What they have is price exposure, not ownership. And this is a very important difference. Because in normal times, everything works smoothly. The price moves, your investment grows or falls, and it feels like real ownership. But in a crisis, the situation can completely change. These products can be frozen. Trading can be halted. Settlements can be done in cash instead of actual metal. And suddenly, the gold you thought you owned becomes just a number on a screen. Another hidden issue is fees. These ETFs slowly reduce their holdings over time to cover management costs. This means that even if the price stays the same, your actual exposure to real metal can decrease over the long term. It's a slow erosion that most investors never notice. Now let's talk about silver, because the situation is even more interesting. Silver markets are heavily influenced by paper trading. There are multiple layers of contracts, derivatives, and financial instruments built on top of each other. And these can be created in large quantities, far beyond the actual physical supply. This creates a strange situation. On the screen, silver prices can be very volatile, going up and down quickly. But in the real world, physical silver can be scarce and hard to find. Why does this happen? Because the price you see is not purely based on physical supply and demand. It is heavily influenced by paper trading. And when there is too much leverage in the system, small changes can create big price movements. We have even seen cases where major financial institutions were fined for manipulating precious metal markets. This shows that the system is not always as fair or transparent as people believe. And even after penalties, the behavior often continues, because the profits from manipulation can be much larger than the fines themselves. So when you see sudden spikes or drops in silver prices, it's not always natural market behavior. Sometimes, it's the result of a system that is heavily controlled by large players using complex financial tools. This is why understanding the structure of the market is so important. Because without that understanding, you might think you are investing in something stable, while actually being exposed to hidden risks. Now let's move to another popular option, mining stocks. Many people believe that buying mining companies is the same as owning gold or silver. But in reality, they are completely different. Mining stocks are not metal. They are company shares. And that means they come with all the risks of a business. A mining company depends on management decisions, operational efficiency, energy costs, government policies, and even political stability. A mine can be shut down. A project can be delayed. A government can change rules or take control. A company can go into debt or even go bankrupt. None of these risks are directly related to the price of gold or silver. Yes, mining stocks can go up when gold and silver prices rise. Sometimes they even move faster. But they can also fall when the overall stock market drops, even if gold is stable or rising. This creates a big difference between speculation and protection. Mining stocks can be used for trading and profit opportunities, but they are not reliable as wealth protection because they are still part of the financial system, the same system we have been discussing. They can be affected by market crashes, liquidity problems, and investor panic. And in extreme situations, access to these assets can also be restricted. Now compare that to physical gold and silver. Physical metal does not depend on a company. It does not rely on a promise. It does not need a system to exist. It simply exists as value. That is why, historically, physical gold and silver have been considered a form of financial insurance. Not for quick profit, but for long-term protection. So the key takeaway is simple. Not all gold and silver investments are the same. Some give you real control. Others only give you exposure inside a system that may not always be stable. If you want to truly protect your wealth, you must understand this difference clearly. If you found this breakdown helpful and want to learn more about how gold and silver really work in today's economy, make sure to follow goldsilver_scope for more simple and powerful insights.